What if the most successful investor in history was sending out a massive warning, but not with his words? What if he was sending it with his actions? Because right now, Warren Buffett is quietly, methodically, and relentlessly dumping stocks, not just by the millions, but by the tens of billions of dollars. For nearly 3 years straight, he's been a net seller of stocks. And what's he doing with all that cash? He's building a mountain of it. A war chest of capital that has now swelled to a record-breaking sum of over $189 billion. This isn't just a defensive move. It's the financial equivalent of a storm chaser pointing his gear directly at a hurricane forming just off the coast. The last time we saw him making moves on this scale, it was in the run-up to the 2008 financial crisis and the dot-com bust. And we all remember how that went. The Oracle of Omaha is getting ready for something big. But why is he doing it? And what does this silent warning mean for your 401k? The answer is a direct threat to your portfolio, and I'm about to give you the plan to defend yourself. Before moving forward, make sure you've subscribed to this YouTube channel. The Oracle of Omaha is getting ready for something big. His company, Berkshire Hathaway, is now sitting on more cash than ever before. He isn't just trimming a few positions. He is systematically selling off stocks in a market that he clearly thinks is priced for perfection in a deeply imperfect world. If you have a 401k, an IRA, a pension, or really any money in the stock market, you need to hear this. The warning bells aren't just ringing, they are clanging. In this video, we're going to break down exactly what Buffett's moves are telling us, decode the economic red flags that are flashing brighter than ever, and most importantly, reveal 3 urgent moves you should consider making today to protect your portfolio and maybe even turn the coming chaos into a once-in-a-generation opportunity. Stick around, because what you learn in the next few minutes could be the difference between financial devastation and financial deliverance. To understand how to protect yourself, you first have to understand the evidence. Buffett's actions are based on a cold, hard analysis of the financial world. And the first clue is the most obvious one. A record-breaking mountain of cash that should honestly terrify you. First, let's talk about why Buffett is doing. As of recent filings, Berkshire Hathaway is sitting on a cash pile of over $189 billion. It's a number so big it's hard to wrap your head around. It's larger than the entire economy of many countries. But the giant number itself isn't the real story. The real signal is the trend. This cash position hasn't just grown, it has exploded to an all-time record. This isn't just a passive pile-up of profits, it's an active and deliberate strategy. Buffett has been a net seller of stocks for multiple consecutive quarters, meaning for years more money has been flowing out of the stock market and into this cash fortress than the other way around. This is not normal behavior for the guy who famously said his favorite holding period is forever. So why is he doing it? In Buffett's world, cash does 2 things. First, it's a shield. When markets get rocky and prices are falling, cash is your anchor. It protects the Berkshire Fortress from the storm. But more importantly, and this is the key a lot of people miss, Buffett sees cash as a weapon. He calls it dry powder. He's not hoarding cash to hide in a bunker. He's hoarding it to go bargain hunting. Buffett's most legendary investments were made when everyone else was panicking, when others were fearful, as he puts it. During the 2008 crisis, while the world was melting down, he was deploying billions, striking incredible deals with companies like Goldman Sachs and Bank of America. He could do that for one reason. He had the cash. By building this unprecedented mountain of money, Buffett is sending his clearest signal yet. He thinks a storm is coming, and he's getting ready to shop during the chaos. He's waiting for Wall Street to have a fire sale, so he can buy amazing businesses at a discount. The fact that he isn't finding many attractive deals at today's prices speaks volumes. His own company's stock buybacks have even slowed down, a move he usually makes when he feels the price is a bargain. That cash isn't just sitting there. It's a coiled spring, waiting to be unleashed. Before moving to the next clue, make sure you've liked this video. The side of that cash equation, the massive, sustained selling of stocks. To build a mountain of cash that big, you have to get the money from somewhere. For Buffett, that has meant selling off chunks of his legendary portfolio. For nearly 3 years, Berkshire has been a net seller of stocks, quarter after quarter. This means he's consistently been selling tens of billions more in stocks than he's been buying. And what's he selling? It's not just pocket change. He's been trimming some of the crown jewels of the Berkshire empire. He sold off significant chunks of his stake in Apple. Now, he still holds a gigantic position, but selling billions of dollars of what he's called the best business he's ever seen is a huge statement. He's also been trimming his massive stake in Bank of America and has significantly reduced other financial positions, like his stake in Citigroup. This isn't panic selling, it's strategic. Buffett isn't dumping everything. He's selectively taking profits, especially in companies that have had huge run-ups in price and might be most vulnerable in a downturn. The message is clear. He believes valuations are stretched and risk is high. When the greatest long-term investor of all time is consistently taking chips off the table, it's a signal you shouldn't ignore. He's quietly telling us that, in his view, the potential reward of staying fully invested right now isn't worth the risk. The third clue is in the economic gauges that Buffett watches like a hawk. And right now, several of them are flashing bright red. The most famous is the Buffett Indicator. He's called it probably the best single measure of where valuations stand at any given moment. It's pretty simple. It's the total value of the US stock market divided by the nation's GDP. Think of it as a price tag for the whole market relative to the economy. A normal ratio is around 100%. As of late 2025, the Buffett Indicator is screaming a warning. It's hovering at historically high levels, well over 170%. That's not just high, it's deep into territory that preceded major market downturns in the past, including the dot-com bust. A reading this high suggests the stock market has become detached from the real economy that's supposed to support it, leaving the market vulnerable to a sharp correction. But that's not the only red flag. There's also market concentration. The S&P 500, which is in almost everyone's retirement account, is supposed to be a diverse mix of 500 companies. But today, it's one of the most concentrated markets in recent memory. A tiny handful of mega-cap tech stocks, the Magnificent Seven, now account for about 30% of the entire index's value and performance. This means millions of people who think they're diversified are actually making a huge, concentrated bet on just a few companies. If these high flyers stumble, they could drag the whole market down with them. Then there's the big picture. After years of rock-bottom interest rates, we're in a new world of higher borrowing costs. Geopolitical tensions are simmering, and government debt is at sky-high levels. When you put it all together, the picture is crystal clear. But these signals, the cash, the selling, the Buffett Indicator, aren't just abstract numbers for Wall Street. They are a direct and chilling warning for your 401k. And in the next section, I'll show you exactly how this setup is designed to devastate your retirement. So, Warren Buffett is selling stocks and hoarding cash. Why should you, a normal person with a 401k, care? You might be thinking, I'm in it for the long haul. That is precisely why this is such a critical warning for you. These forces aren't just abstract numbers. They could have a devastating impact on your retirement plans and your family's financial future. The first brutal reality is the potential for huge losses. If you own an S&P 500 index fund, your diversified portfolio is actually making a massive bet on a few tech giants whose valuations are stretched to historical extremes. When a correction comes, it might not be a gentle dip. A fall in just those few stocks could trigger a domino effect, wiping out a big chunk of your portfolio's value in weeks or even days. Remember the dot-com crash? The Nasdaq lost nearly 80% of its value between 2000 and 2002. Remember 2008? The S&P 500 plunged by more than 50%. People nearing retirement saw their life savings cut in half. They had to work for years longer or drastically scale back their dreams. The signals Buffett is sending today are eerily similar to the ones that came before those crashes. He sees a market priced for perfection, and he's acting on it. The real question is, are you? Beyond the numbers, there's the psychological warfare of a crash. When you see your account balance dropping 20%, 30%, or more, every instinct will scream at you to sell. The news will be a 24/7 panic fest. This is the moment when real wealth is destroyed. It's not the market drop that ruins people. It's selling at the bottom, locking in those losses, and being too scared to get back in. The people who panic sell are essentially handing their future wealth over to the patient investors, the Warren Buffetts of the world, who are waiting with cash to buy up those same assets at a massive discount. And what if it's not a crash, but a long, slow grind? After the 2000 peak, it took the Nasdaq 15 years just to break even. Can you afford for your retirement portfolio to go nowhere for the next decade? Close quote. The risk isn't just a sudden crash. It's a lost decade that could derail your long-term goals. So acknowledging this fear is step one. But fear without a plan is useless. So in this final, most important section, we will move from fear to action. And I'll give you the exact 3-step playbook Buffett himself would use to thrive in the coming chaos. Michelle. Okay, acknowledging the risk is step one, but fear without a plan is useless. The fun part is that you can use Buffett's own principles to build a stronger portfolio. It's not about crazy trades. It's about discipline and common sense. Here are 3 urgent moves to consider making today to not only protect your portfolio, but to get ready to thrive. The first and most immediate move is to copy the Oracle himself. Build your own fortress of cash. For the average investor, this is just as critical, if not more so. First, defense. In a market freefall, cash is your anchor. It doesn't go down. It's a psychological buffer that stops you from panic selling at the absolute worst time. It helps you sleep at night. But, like Buffett, you have to see cash as a weapon. A market crash is a giant sale. When everyone else is freaking out, that's your moment of maximum opportunity. But you can only go shopping if you have the cash, the dry powder, to do it. So, how much? It's personal, but many advisors suggest that in today's environment, holding 10 to 20% of your investment portfolio in cash or cash equivalents could be a smart move. You can start building this now by directing new contributions to a cash account, or by trimming some big winners in your portfolio. And don't just let it sit in a checking account. Put it in a high-yield savings account, a money market fund, or short-term T-bills, which are currently offering great risk-free returns. This move, can turn you from a potential victim into a potential predator. The second move is to Marie Kondo your portfolio. As Buffett says, when the tide goes out, you discover who's been swimming naked. A crash separates the high-quality businesses from the speculative junk. Your job is to make sure you own the good stuff. What's a quality business? It has what Buffett calls a moat, a durable competitive advantage like a powerful brand, think Coca-Cola, or a unique network, think American Express. It has pricing power, meaning it can raise prices without losing customers, which is crucial in an inflationary world. And it has a strong balance sheet with very little debt. Look at the few things Buffett has been buying. While selling a ton, he's put money into cash-gushing energy giants like Chevron and Occidental Petroleum. These are companies that do well when there's inflation and provide things the world absolutely needs. So look at your own holdings. Ask the tough questions. Does this company have a real moat? Is it financially strong? Would you be happy to own it if the stock market closed for 10 years? If the answer is no, consider trimming that position and moving the money into your cash stash or into higher quality companies. Weeding the garden now is essential. This final move might be the most important. Buffett says the most important quality for an investor is temperament, not intellect. You have to master your emotions. Embrace Buffett's most famous mantra: be fearful when others are greedy, and be greedy only when others are fearful. Right now, the market is greedy. It's time for you to be prudent. Build your cash. Focus on quality. When the crash comes, and it will eventually, the world will be gripped by fear. That's your signal to get greedy. That's when you deploy your cash, buying wonderful businesses on sale. This is easy to say now and incredibly hard to do in the moment. The only way to win is to have a written plan before the crisis hits. Create your own in case of market crash playbook. It can be simple. If the S&P 500 drops 20%, I will invest 1/3 of my cash. If it drops 30%, I'll invest the next third. This takes your panicking brain out of the equation and forces you to stick to the rational plan you made when you were calm. Stop checking your portfolio every day. That's like picking at a scab. Remember, every single crash in US history has been followed by an eventual recovery to new all-time highs. Your job isn't to dodge the storm, but to build a ship that can sail right through it. The warning signs are there, and now you have a game plan. If you found this breakdown valuable and want more strategies from the world's greatest investors, make sure you hit that subscribe button and turn on notifications so you don't miss what's next. And now we want to hear from you. What are your biggest worries about the market right now? Are you building up a cash position? Drop a comment below. Sharing what we're all doing is one of the best ways to get through these crazy times together. So, what's the bottom line? The evidence is compelling. Warren Buffett, the most successful investor of our lifetime, is making his biggest defensive moves in years. By building a record cash hoard of over $189 billion and selling stocks for nearly 3 years straight, he's sending a clear, silent warning. Get ready. We've shown why this isn't just some news story. It's a direct threat to your 401k and your retirement dreams. But we didn't leave you with just the fear. We gave you a 3-step plan based on Buffett's own wisdom. Build your cash fortress, upgrade your portfolio to quality businesses, and master your emotions with a written plan. Market crashes are a feature, not a bug. They are how wealth gets transferred from the impatient to the patient. By heeding the warnings and taking these steps today, you can make sure you're on the right side of that transfer. The goal isn't just to survive the crash, but to emerge on the other side stronger than ever. Thanks for watching.